Let's talk about gold and silver. Now, you've probably heard them mentioned in the same breath, like they're two sides of the same coin. But are they really identical twins when it comes to investing? Well, today, we're going to dig into the data and uncover their true relationship, which is actually a lot more interesting and different than you might think. So, let's dive in.
You know, if you pull up a long-term price chart of gold and silver, you'll see exactly why people think this. You get these two lines, and for years, even decades, they look like they're dancing together, just drifting in the same general direction. It's so easy to look at that and just go, okay, they're basically the same thing. But that's where the real story begins.
Because here's the paradox, right? Even though those big long-term charts look like they're joined at the hip, as one analysis put it, if you zoom in, if you look at the day-to-day or month-to-month action, those wiggles can feel totally unrelated. Sometimes one zigs while the other zags. And that's the tension we're going to explore.
So this really leads us to the most important question for anyone thinking about investing in them. Is that long-term visual similarity the only thing that matters? Or are those shorter-term wiggles telling us something much more fundamental about how these two metals actually behave?
To get to the bottom of that, we've got to crack the code. And the way we do that is by looking at the data in two completely different ways. We need to compare price levels with month-to-month returns.
All right, let's make sure we're on the same page here, because this is super important. When we say levels, we're talking about the big picture, that long, slow drift on the chart over many years. But when we say returns, we're talking about the wiggles, the actual percentage you gained or lost in one specific month. And believe me, understanding that difference changes everything.
Okay, now let's put some hard numbers on this. We're going to use something called correlation. It's just a score from -1 to +1. If it's +1, two things move in perfect lockstep. And as you can see, when we look at the price levels, the correlation is incredibly high. It basically confirms what our eyes were telling us from that long-term chart.
Yeah, look at that number, 0.962. I mean, in the world of financial markets, that is about as close to a perfect +1 as you are ever going to see. This is the hard data behind that twin illusion. It proves that, yeah, over the long haul, their prices have pretty much drifted together.
But then, and this is the aha moment, look what happens when we switch gears and measure the correlation of the monthly returns. Bam! The number just plummets to 0.475. Now that's not zero, they're still related, but it is a world away from 0.96. This tells you that knowing what gold did this month only gives you a kinda sorta clue about what silver did.
So, the huge takeaway here is that silver is not just gold with some extra wiggle. It's not just a cheaper, jumpier version of gold. It really has its own distinct personality, especially when you look at it month by month. And that personality is driven by something else entirely.
So, if silver has its own personality, what defines it? Well, to really understand those wiggles, we need to talk about volatility. In simple terms, that's just the size of its typical price swings.
And this chart just lays it all out, doesn't it? We're looking at standard deviation here, which is just a fancy way of measuring a typical monthly price swing. For gold, that's about 4.8%. But look at silver. It's 9.8%. It's not even close. You can just see how much more dramatic silver's moves tend to be.
In fact, let's boil this all down to one single number. If you take silver's volatility and divide it by gold's, you get 2.05. That means, historically, silver's month-to-month ride has been more than twice as choppy. It's not just a little extra wiggle, it's a fundamentally different, more volatile beast.
Okay, so this relationship is clearly complex and it's always shifting. So how can we keep track of it in a simple way? Well, investors have a really handy tool for this. It's called the gold-silver ratio, and it's a fantastic way to get some historical context all in one number.
And the definition is actually really straightforward. It's just how many ounces of silver does it take to buy one single ounce of gold. That's it. So, if the ratio is really high, like say 80 to 1, it means silver is pretty cheap compared to gold. If the ratio is low, maybe 30 to 1, then silver is relatively expensive.
And just look at the historical range of this thing. I mean, wow. Since 1971, it's been as low as 14 and as high as 112. The median, or the typical value, is right around 62. That enormous range just tells you how dynamic and how much the relative value between these two metals has swung back and forth over time.
So this all leads us to the really practical question, right? Can we actually use this ratio for anything? What does history tell us about what tends to happen when the ratio gets stretched to one of those extremes?
To put it another way, when that ratio gets super high or super low, has that historically been a signal about what might happen next for prices? I mean, this is the question every investor wants to know.
So let's see what the data has to say.
All right, so what happened? Well, looking at the data since 1990, whenever the ratio got really high, above 73, meaning silver was historically cheap, the next year was often pretty darn good for silver. On average, silver's return was a positive 17.4%, and it outperformed gold by more than 8%.
But, and I cannot stress this enough, this part is critical, an average is just an average. It's like a center of gravity. It hides all the different individual outcomes. Some of those times silver went to the moon, and other times it actually lost money. This is a historical tendency, not a crystal ball.
And this chart really drives that point home. What was the so-called hit rate? Well, about 65% of the time, silver did have a positive return over the next year. But that means 35% of the time, it didn't. Now that's definitely better than a coin flip, but it is far, far from a guarantee.
So we'll leave you with this final thought. Gold and silver, they aren't twins. A better way to think of them is as siblings. You know, they have a strong family resemblance, but they have very different personalities. One is the steady, reliable one, the other is the volatile, dramatic one. So knowing this, how does it change the way you look at them, not just on a chart, but in your own thinking?